Welcome back to PyUncut Market Breakdown, where we decode the biggest moves in markets and make sense of what's driving investor sentiment. Today we're diving into one of the most talked about stocks on the planet, Tesla, TSLA, which just reported nearly 500,000 deliveries in Q3. With the company set to report earnings on October 22, the big question is Tesla still a buy after its incredible run? Tesla's rally from doubt to dominance. Over the last 6 months, Tesla's stock has soared nearly 80% and about 35% just in the past quarter. That kind of surge would normally signal massive investor optimism, and this time, it's backed by strong delivery data. Tesla delivered 497,009 vehicles in Q3, a 7% increase year over year, beating Wall Street expectations. That's a huge psychological milestone, especially after a bumpy 2024 when EV demand looked uncertain. But what's behind this delivery surge? Partly a rush before the $7,500 federal EV tax credit expired in September. Many buyers accelerated their purchases to grab the credit before it ended, a short-term boost that helped Tesla post strong numbers for the quarter. What the market is expecting for Q3 earnings? Wall Street is currently expecting Tesla to report earnings per share of EPS of 41 cents, down from 62 cents last year. That's about a 34% year-over-year decline, even though deliveries are higher. So why the drop? Tesla has been cutting prices aggressively to maintain market share against growing competition, from legacy automakers like Ford and GM to Chinese players like BYD. Lower prices mean thinner margins. However, bulls argue that improved production efficiency and a better product mix, especially more deliveries of the high-margin Model Y, could help cushion those margin pressures. Still, with the stock already pricing in perfection, any earnings or guidance miss could trigger a sharp sell-off. Options market? Traders bracing for volatility. The options market is signaling a 7.3% post-earnings swing in either direction, slightly below Tesla's historical average of around 9.6%. That tells us two things. Investors expect movement, but not chaos. Expectations are elevated, and if Tesla doesn't deliver a narrative as strong as its stock price, we could see a short-term pullback. Remember, after its last earnings report, shares fell 8.2% the next day, a reminder that Tesla's volatility cuts both ways. Beyond cars, Tesla's AI and Robotaxi vision. Tesla's growth story is no longer just about selling electric cars. The company's pivot towards AI, robotics, and autonomous mobility is what keeps long-term investors excited. In June, Tesla officially launched its long-awaited Robotaxi service, a bold step towards monetizing self-driving technology. This isn't just about fancy tech, it's about transforming Tesla's business model into a recurring revenue engine, similar to what Apple did with services. If Robotaxi scales successfully, Tesla could one day earn subscription-like income from self-driving rides, drastically improving margins and reducing its dependence on cyclical vehicle sales. Its full self-driving system, FSD, continues to evolve, giving Tesla an edge in the autonomous space. While FSD is still under regulatory scrutiny, every incremental improvement pushes Tesla closer to becoming the first company to make fully autonomous driving mainstream. Efficiency, affordability, and the next chapter. After the EV tax credit expired, the next challenge for Tesla is keeping demand strong. The company's answer? More affordable variants of its popular models. Lower-cost versions of the Model 3 and Model Y, possibly under $40,000, could open Tesla to a broader customer base. Combine that with production cost reductions at gigafactories in Austin and Berlin, and Tesla can maintain healthy volumes even as pricing pressure intensifies. On the production side, Tesla continues to make quiet but meaningful progress in manufacturing efficiency, from advanced casting technologies to battery supply chain optimizations. These incremental improvements add up to long-term cost advantages. Investor sentiment? Hope meets valuation reality. Here's where things get tricky. Tesla trades at an eye-popping 370 times forward earnings, a valuation that makes even high-growth tech stocks blush. For context, Ford trades around 7 times forward earnings, General Motors around 5, even Rivian sits below 50 times. This means Tesla's valuation already assumes massive future growth, not just in cars, but in robot taxis, AI software, energy storage, and robotics. Yes, analysts project Tesla's EPS to jump 67% by 2026, but that's still a long road ahead. If growth disappoints or margins continue to compress, the market may rethink how much future success is already priced in. The big picture? Why Tesla still matters? Even with the valuation concerns, Tesla remains one of the most important stocks in the global market, a bellwether for innovation and investor sentiment around the EV and AI revolutions. Every major automaker is chasing Tesla's playbook: vertical integration, over-the-air software updates, and battery efficiency. Meanwhile, Elon Musk's long-term focus on AI and energy storage keeps Tesla in the headlines and in investors' portfolios. For long-term investors, Tesla isn't just a car company. It's a platform for multiple trillion-dollar industries converging: EVs and clean energy, autonomous mobility, AI and robotics, and grid-scale energy storage. The question isn't whether these markets will grow. They will. The question is whether Tesla can maintain its leadership and profitably scale across them. PyUncut takeaway: should you buy before earnings? Here's our balanced view. Short-term traders should tread carefully. With the stock up 80% in 6 months and expectations sky high, Tesla could easily sell off on even a modest earnings miss or cautious guidance. Long-term investors might see any pullback as an opportunity. Tesla's innovation pipeline, from AI-driven vehicles to energy solutions, remains unmatched. Think of Tesla as a long-term call option on the future of transportation and automation. Just be aware you're paying a steep premium for that potential. Risks to watch: competition. Chinese EV makers are expanding aggressively. Margins. Ongoing price cuts may erode profitability. Regulatory hurdles. FSD approval timelines remain uncertain. Macroeconomy. Higher interest rates could pressure car sales. Closing thoughts. As we count down to Tesla's Q3 earnings, the market narrative feels split in two. The bulls see Tesla leading humanity into a driverless, sustainable future. The bears see a stock priced for perfection that can't afford even a small stumble. Either way, Tesla is once again at the center of the investing universe, a reminder that in the stock market, belief and valuation often collide. So, whether you're holding, buying, or waiting, stay tuned, because when Tesla moves, the market listens.